as more and more rehypothecation occurs and your activity is dependent on a longer and longer chain across ecosystems, your risk is going up and you don't necessarily appreciate that.
Anything outside of the layer one, which is the chain native staking, it's all stacking on risk premium on top. So you're compounding your risk. All these institutions are not going to jump into DeFi. I mean, for all those that are saying, okay, institutions are coming, that's not going to happen immediately.
You need real activity to inform the rate, not just guesses. You need proper incentives so that people don't try to manipulate the data that feeds the benchmark rate.
If the ETH staking APY is like roughly the same as the risk-free rate in TradFi, then if you gave money to the government and in return got US Treasury bills and then borrowed against those, that's kind of the same as receiving your staked ETH liquid staking tokens and then borrowing against those in the crypto world.
If you're incentivizing people for accuracy and slashing them or penalizing them for inaccuracy, have you not created incentives for them to drive activity or data to show that they're right and therefore get rewards?
It's a decentralized world. So if we're to build a benchmark rate of sort, rather than rely on one intermediary, let's create a concept with some incentive structures in place that can power a decentralized benchmark rate.
All right, Brandon, welcome to the Building in Public podcast. You're the co-founder of Treehouse Finance, which is building the infrastructure for decentralized fixed income products. This is a really special episode for me because I'm joined by my dad, James Lovely. And as a co-host, he's an expert in structured financial products and TradFi benchmark rates that we're going to talk about on this episode, like LIBOR and SOFR. He was the general counsel of Nomura's swap dealer back in the day and MD in structured products at Bank of America and has 30 plus years of experience with derivatives. And he was also into crypto before I was. So I remember he was prattling off about Bitcoin and Ethereum and, Bitcoin as digital gold and, potentially better form of money. And I ignored it all. And I wish I paid attention and bought some, because that was probably back in 2016 or 2017. But now I'm in the space. Helium gets all the credit for that, and excited for this interview today. So Brandon, I want to start with you. You were working in TradFi and fixed income before crypto and Treehouse. So what did you like about, that industry, fixed income specifically, that then made you want to jump into the world of crypto and work on the same kind of topics or ideas, but in our space?
Yeah, I mean, hey, thanks for having me. Really nice meeting you, Connor and James. Excited to have your dad on. Great to see another fixed income guy that's active in crypto as well. Let me just give a quick brief run through of my background. So prior to starting Treehouse, I was at Morgan Stanley. I was doing credit as well as interest rate derivatives. Not as long as James. I was in the space for 6 years. And how I got into crypto really was, I was on the trading desk. I had a bunch of friends on the desk as well that were very, very degenerate together. So while we were doing our jobs in the day, by night, we will be all, basically pinging each other, talking about all the degenerate plays that we can do, the ICO days. And I think what really kind of, flipped me, like gave the switch for me to jump into crypto was when Uniswap first came out. So I was sitting on the market making desk, and when I read the Uniswap white paper and I tried it, I was like, wow, I mean, this is really, one of the best applications of blockchain at that point of time. And I saw how you can automate market making, which kind of blew my mind. So at that point of time too, I had a couple friends that moved from TradFi to crypto. One of them started Amber, a very big market maker. A few others started hedge funds. When I saw exodus, a bunch of friends started going to crypto, I thought, hey, it's time for me to kind of jump over. And why fixed income? Actually, Treehouse started when I was actually building a portfolio management system that just for myself, just to trade DeFi. I went pretty deep into it, built a very extensive system that a lot of our friends just wanted to use it, and I saw a business opportunity. So Treehouse actually started as an institutional PMS, and then it slowly evolved into what this decentralized fixed income layer that we're pushing out now.
Super cool. Yeah, the best products come about organically, and oftentimes we're designed for the designer's use, right? So in this case, yours. So that makes a lot of sense. Maybe to level set us a bit and zoom very far out, how are different borrowing rates usually determined in the TradFi world? And this is taking me back to some master's in finance classes, for instance. But like, is an interest rate just a way to price default and other types of risk, or is there something else? Like, how do you think about the core financial tenet of an interest rate and what makes it up?
Yeah, I think maybe I'll just talk about the concept of risk and return. They're pretty much the same side of the coin. When you talk about risk and return, there's really two big subsegments that I tend to look at it. One of which is the risk-free rate as the very bare bone. That's the minimum yield that you should receive. And then everything else is pretty much like the risk premium, that additional risk that you're taking. So when you look at not just interest rates, right? When you talk about equities, everything, it's a subset of this risk premium, right? That comes with it. I'd love to hear James's opinion on this as well. But obviously, you start off, when you look at assets in general, you start the risk-free rate spectrum, and then you start adding on. You start off with even safer things like generating TradFi. I know there's like rating agencies that help give you a gauge of how safe a particular investment is from the fixed income world. So that's generally starting with like the triple A's, government bond, sovereign bonds, and then it kind of levels down into credit, into investment grade, and then high yield. That's what they call it.
The components of an interest rate are pretty well known, as Brandon said. You have a real rate that compensates you for time preference, right? Buying something or doing something today versus in the future. You have a credit risk component, which you need to estimate, and that's usually done through external sources like rating agencies or diligence financial statements. And then you've got, inflation, right? Getting paid $1 in the future is not like today, because the value of a future dollar is not the same, or a future return. And then you have term structure issues, right? But those I wouldn't think, Brandon, that those basic theoretical components of a rate will differ in the decentralized world versus the TradFi world. So I think there's a lot of commonality for anybody crossing over to already understand those components.
Yeah, it makes a lot of sense. So let's talk about on-chain rates now. So before we talk about liquid staking, Brandon, as I was doing the research for this podcast, I felt great because DePIN is more of the sector that I like cover, have knowledge and experience in. I mean, I have a finance degree, but I'm not as close to the DeFi stuff. But I kind of also came to the same conclusion, which I think you have, and I think I saw at least one or two tweets from the Treehouse account about the ETH proof of stake APY being basically like the risk-free rate you guys kind of said like in crypto broadly, but I think like obviously specifically for the Ethereum protocol or the Ethereum ecosystem as well. So I came to the same conclusion, and I'm just curious your thoughts there, why maybe like the Bitcoin proof of work APY is not, and just how you think about the risk-free rate both on chain generally and also within specific blockchain ecosystems like Ethereum versus Solana versus Bitcoin.
Yeah, I think there's a lot of similarities you can bring from TradFi into DeFi. I've written a piece on this actually. So I've segmented DeFi risks into three specific layers. The first layer, which I call layer 0, not obviously not the bridge, but it's a layer where internet infrastructure is, where it's your wallet infrastructure. That's pretty systemic stuff. There's inherent risk there. There's that could actually go down potentially, but it's very hard to price that, right? And then we call the next layer layer 1, and that's exactly what you mentioned. It's chain specific, whether it's Bitcoin, whether it's Ethereum. They all, you can't really put them in the same exact field, but I just call it very broadly the chain layer. And then on layer 2, I throw in a few things such as like smart contract risk, bridging risk, liquid staking protocol, and then when you interact with specific protocols, on top of that smart contract risk, there's also market risk, there's counterparty risk. So all these additional risk premium that you can kind of throw on. And then just to also answer your question about like looking at what the risk-free rate is in crypto, right? I think we have to really independently treat every blockchain as in its own world. So let's start with Bitcoin because you brought that up. Bitcoin to me, it's not perfect as an analogy, but it kind of reminds me of like gold in traditional finance. Because if you want to get more gold in the real world, you can't throw more gold at it, right? You have to hire like people, you need to get machinery, you're gonna have to mine, right? Whether it's under the sea, whether it's like somewhere far away, you have to basically ship things over there and start mining. The cost of getting more gold cannot be perfectly tied to an amount of gold that you put in. It's another derivative. It's like energy that you put in, it's labor that you put in. So similarly, like again, Bitcoin, right? If I want to get more Bitcoin, I don't throw more Bitcoin at it. I actually need to throw more energy at it to get more Bitcoin. So that's the analogy that I like to use where, especially looking at gold and TradFi now, coming back to it, you don't really have a risk-free rate, but you have an implied risk-free rate. It's basically taking the basis trade for gold, trading the futures and the spot, but that's an extremely volatile rate. So people don't naturally use it all the time, but you can still use it. Now coming to Ethereum, I like to use the analogy that Ethereum mimics a country. So let's try to put it side by side with the United States, right? Let's put them next to each other. At the top, you have the US dollar. It's the currency that powers the United States. It runs the economy. Everything is all transacted in the US dollar. Over here, if you look at ETH, which is the Ethereum nation, same story, right? Everything is transacted. Gas fees is all powered for that. Now, the one level below that, we have like the Federal Reserve. We have the government, and that kind of sets really the vision and the rates and everything. It's all kind of powered by the government, right? But coming back to Ethereum, I think it's the proof of stake system, and I think it's very systemic because if proof of stake dies, Ethereum's dead, right? Proof of stake is a system that is powering the Ethereum nation, is keeping it going. And the best thing about it is that with proof of stake on Ethereum, I can actually put a yield on it, right? I can take ETH, put it into this, proof of stake, whether you stake it yourself or you do liquid staking, and there's a yield that can come from it. This for the United States, that would be the treasury curve, right? That's what people would normally say the risk-free return is for a US dollar. So I think the parallels are there. It's not a perfect analogy. There's a lot of things that we can get down into the details where when you get down into staking, the components of that what gives you the return is obviously very different from the US, but fundamentally that's how I kind of piece them together.
Yeah, I think that makes sense. I mean, I liked the gold analogy of like mining for gold. You can't just throw more gold or money at the problem. Like there's a labor component. I mean, you could probably price the labor like in terms of gold and kind of bundle up the whole how do we get more gold into like just a amount of gold problem, but it's probably non-linear in terms of the payout, right? Like you can fund a whole team to go find gold, but like will you find the gold? There's like a component of variability there. So I think that makes sense. I mean, do you guys view the Ethereum proof of stake like APY as the risk-free rate in crypto?
No, I mean, because I'm always, obviously I'm much older than you guys. So I operate by analogies to the world that I've lived in. And, the way I think about, as Brandon said, Ethereum, it's like a country. So the way I think about staking yield is like interest on reserves at the Fed. Like you're getting that yield directly from the mothership of the ecosystem. When you go beyond direct staking yield paid by the protocol, whether that's yield on liquid staking tokens or some other activity, you're moving further away from the center. So the analogy in the TradFi world would be centrally cleared repo is not the central bank, but it's pretty solid. And maybe that's like, getting some kind of yield at one level of decentralized finance. But then, if you go to bilateral repo or even private lending against treasuries or collateral, you're moving further away from that center. And now your level of risk is growing because, as Brandon said, you have counterparty risk. If you're dealing across borders, you have cross-country border risk, legal risk, regulatory risk, other things. And so, I always try to, when I'm looking at these kind of issues, I try to figure out how far away am I from the center and what risk set am I now dealing with? And it changes depending on, where you are. And then Brandon, when you go to bridging and other chains, now your risk is like, factorial.
No, that's a great point. And I think when you look at risk-free rates in general, like even for TradFi, I'm not too familiar with the history of it, but I'm sure it took some time for the entire I guess financial world to come together and say, okay, let's use this, right? I think even coming up with the concept of LIBOR as the preferred benchmark, right, where it's good enough interbank
Right.
versus when you're doing credit, you should instead trade it as a spread over the government bond. It's a convention actually, right? It's not perfect. Like if you look at the U.S. Treasury rate, it's in theory, it's not risk-free, right? there could be nuclear war. I don't obviously those are very, very like layer
Right.
zero risk, but it's ultimately a convention. So I think it's like we're at a point where it's safe to say like proof of stake is pretty systemic, and it's very hard to go any further back.
Yeah, and Brandon, rather than asking you to explain liquid staking, maybe just let me quickly give an explanation and then you can fill in any gaps just so we save time. But basically my understanding is that you can, if you own ETH, you can deposit it to function in the consensus mechanism, which is proof of stake for Ethereum. And in return for essentially locking up your tokens, you receive an APY, which I think is around like 2 or 3%. But within that mechanism, say you stake natively with Ethereum or you stake with a liquid staking provider, either way, do you receive basically like staked ETH or like a representative token back from the protocol / staking provider in your wallet that represents and is redeemable for the native Ethereum that you locked up? Like how does that process work?
Yeah, I can briefly touch on it. So you can, there's two options in this when it comes to proof of stake. One is you can do it yourself, right? You can run a node, and essentially that's you getting like 32 ETH, staking it and spinning up a node to then help. You're actually doing work to find proof of stake, basically putting a stake down, and doing some form of computational work to keep the system running, to keep everything checks and balances, etc., to make sure that no one's lying when they're spinning up the next block. And the other new concept that was first came out through Lido was liquid staking, and they essentially just abstract away all the work. They do it for you, and they give you a representation of the yield that is implied from it. There are actually a lot of nuances when it comes to staking, because if you're a one-person staker, you have exactly 32 ETH and you put it in there, your return profile would actually be very, very volatile. You might only get like the minimum yield, which could be as low as like 0.01% every day. And then every 100-day, you might get a massive like pickup in return because just the nature of how proof of stake works. So what Lido does is that it actually helps normalize that rate. So, given that everybody kind of joins their stake together, so it doesn't really matter which block wins. Ultimately, it's 30% of today right now of the staking market is held by Lido, and that helps make the volatility a lot lower. But there are many components that make up what this proof of stake yield is. One of which is just doing the underlying work. There's a very, very big factor that is a fairly new concept when Ethereum moved to the proof of stake system, and it's MEV. So MEV can actually distort your return quite heavily nowadays. And ultimately there's so many components of it now. So liquid staking actually helps abstract away all that issues rather than, being an individual staker and just seeing that volatile. Well, it won't even look like that. It would be like super low and just one spike every 100 days.
And also you receive more capital efficiency in exchange for potential rehypothecation risk, right? Because I guess if the ETH staking APY is like roughly the same as the risk-free rate in TradFi, then if you gave money to the government and in return got US Treasury bills and then borrowed against those, that's kind of the same as receiving your staked ETH liquid staking tokens and then borrowing against those in the crypto world, right? Does that analogy hold up?
So what liquid staking does as an additional feature that staking by yourself can't do is that now that you have this representation, and in the case of Lido, it's WST ETH, you can take it and do things in it in DeFi. So you can use it as collateral to then borrow, like what you said, rehypothecate. You can do it. You can put it into Eigenlayer. There's a lot more things that you can do. So it makes a lot more sense to abstract away firstly all the node work to Lido and to the validator set. And then the second thing is that you now have this token that you can do a lot more things with.
Gotcha. And then specifically for Treehouse, what does your T asset product enable with respect to liquid staking? And what does the user experience look like? Like if I had Ethereum and I was looking at this as a potential solution.
Yeah, sure. So T assets is a new concept that we launched, and we call it liquid staking tokens 2.0. And really what it is underlying, we're working directly with Lido. So we're great partners with Lido. When a user deposits their ETH into the smart contract, we actually move it to WST ETH. But from there, we do an additional step, which is we do a simple arbitrage strategy. So the three main features of what TETH does specifically, because we started in the Ethereum world, the first of which is it's democratized access to this particular trade. So anybody, we're kind of doing one level deeper from what Lido is abstracting away, which is if you stake ETH, you can now earn not only the Lido yield, you can earn this pickup in yield as well, which can range anywhere from 30 bips to 80 bips annualized. There are some days where it can spike, right, just because of the MEV opportunities or borrow lending mismatches. But in general, it's around 30 to 80 bips annually. The second feature is that by doing this particular strategy, the underlying strategy that we're doing, what we're trying to achieve is to keep the market efficient. The DeFi world is very, very fragmented, right? It's almost like coming back to TradFi, going out there to the street and saying, hey, I want to borrow US dollar. There might be someone out there that's lending US dollar 1% when the risk-free rate is 4%, which doesn't really make sense. So you're going to take it, right? And that doesn't really exist in the traditional finance world. I mean, it could, if it's your dad lending you money, maybe it's 1%. But if it's the market, that's not going to happen, right? So
right.
In DeFi, it's extremely, extremely inefficient and fragmented. So by doing this trade, we're helping to converge all these interest rates. That's our goal among the top protocols, at least the ones that are battle tested. So that's the second feature. And the final feature is that T asset is not just LST 2.0. It powers D.O.R, Decentralized Offered Rates. I'll come to that later. I'm sure you have a lot of questions on T asset first. Yeah.
So, Brandon, I had a kind of follow-up question on this whole world of decentralized finance, because to be honest with you, beyond basic staking or, delegated staking with a, large player, I kind of, again, analogize to the world of credit derivatives. Given your background, I'm sure you know what those are. For the listeners, it's basically a form of credit insurance. So a credit derivative pays if a reference asset or reference issuer defaults on a bond or a loan. And in the world of credit derivatives, if I'm writing credit protection on a portfolio, my risk actually of having to pay out increases as the portfolio's size increases, which is kind of counterintuitive. It may be that the magnitude of loss goes down depending on how the portfolio, you're insuring is structured. But if you put more names and more loans and bonds in there, the likelihood that one of them goes bad goes up. And in the world of DeFi, particularly as you move away from the nodes and direct staking yield, I worry that you're kind of in a similar situation and don't appreciate it. As more and more rehypothecation occurs and your activity is dependent on a longer and longer chain across ecosystems, digital ecosystems, your risk is going up and you don't necessarily appreciate that. And so I'm curious if you, from your background, have any thoughts on that issue, the risk that as activity and rehypothecation grows, your risk, given how far down you are in the chain, or the fact that your activity spans multiple chains, it's not within one kind of known ecosystem, that your risk goes up materially. How do you think about that?
No, I mean, I completely agree with you, and it comes back to the initial framework that I mentioned, right? Anything outside of the layer one, which is the chain native staking, it's all stacking on risk premium on top. So you're compounding your risk. And I think the space is maturing, right? I mean, when you talk about the DeFi
Right.
summer back then, you had like Wonderland, you had Ohm that was paying out literally 1,000,000% APY, right? I mean, it was hundreds of millions in there, right? It was insane. But things are slowly kind of. I mean, I don't know if we're there yet, but we're definitely going towards yields being compressed and people really understanding the underlying risks when they enter something. Ultimately, like even now, like I mean, there's so much things we can talk about, but I'm just kind of pinpoint like points. Back in the day when you did a new chain, when you get into a new chain, there was no such thing as coins. You're literally taking a bet that you will get some form of return in a form of an airdrop in the future, which there is no comment. There's nothing written about it. There's nothing said about it. At least nowadays, I mean, like we have the concept of points, right? Which can for certain protocols, you can kind of derive a return behind that. And I think we are maturing, but I completely hear you and I completely agree with you. And maybe this is more of a view of mine, which is that at the state of where we are in crypto today, um, talking about what could drive the space, I think one big factor would be obviously institutions, new money coming in, right? Basically inflows, right? I mean, but the problem with that is if we look at the flow of capital for institutions since crypto existed, so we had Bitcoin that came out in 2009. And then in 2012, we had GBTC. So that was the first ever like institutional access product where you can get access to Bitcoin without holding a wallet. And they made it easy in a form of unit trust. From there, in like 2016, you had a bunch of exchanges. Then you had BitMEX. They came out with the concepts of perpetuals. And you had Ethereum that came out. Then you had like Binance, Bybit, and all these guys started coming. Deribit came out in 2018, so that was the option world. 2019 onward, that was when DeFi came about. Where are institutions right now? We're only at the state where they've just accessed it through Bitcoin ETF, and then more recently ETH ETF. All these institutions are not going to jump into DeFi. Like, I mean, for all those that are saying, okay, institutions are coming, the meme that people post about, that's not going to happen immediately, right? They're not going to jump into the tail end. They're going to, in my view, I think institutions, the next step would be a simple thing as now that you can stake, now you can hold Ethereum ETFs, you can stake that ETH. That's the next level, in my opinion. And which kind of ties in nicely to fixed income, because once you can stake, you're getting, all these institutions are getting a return on a block by block frequency. The next step for me after that is that nobody wants a variable rate, right? They want to fix it. And in order to fix it, you're going to need to get into like interest rate swaps. You need to get into a forward. And there's no infrastructure for that. So that's why we're focusing on building benchmark rates. And then the second topic I want to bring up also is like, where are we in the space of, you mentioned like there's so much risk. I think right now in crypto, there's really only 5 main products that's doing well, or that has real product market fit. And this might be a bit touchy, but the first one is exchange flow business, right? So obviously all the exchanges are profitable, right? They've made a lot of money. And then one level below that, all the supplementary companies that kind of service them, whether it's prime brokers, like Falconize market making, that's all flow. The second one is leverage. If you look at the top protocols in DeFi today, leverage, people love to leverage, right? And the most profitable ones of them are like Aave, Pendle. Pendle is actually a points casino, right? It's like a way for you to leverage points. The third thing is actually meme coins. So like casino, there's clearly demand for that. People love to gamble. The fourth one is proof of stake. So layer one chains, as I was talking about, Ethereum. And then finally, I think narrative. Narrative is very important. Like Eigenlayer is a narrative. And of course you have all the, as I mentioned, below them, there's a lot of infrastructure that's powering, such as Chainlink.
Gotcha. And then, yeah, last question from me, and then we can jump into the rates section. But how do you think about expanding to other layer one chains, layer twos on top of the Ethereum ecosystem? Like, yeah, what factors are you considering when you look at expanding to other chains? And then also, what does your go-to-market motion look like in terms of integrating with their assets and their financial products?
Yeah. So right now for T assets, we're only on Ethereum, and then we've allowed individuals to bridge assets to other chains. So one of them being Arbitrum. Very soon we're going to be on Base as well. The criteria for that is, ultimately getting more users, right? To giving them the ability to deposit and to participate in LFC 2.0 to earn this additional pickup and yield. Where we plan to go from there, we're looking to, we just kind of go down the list of, like, in terms of usage, in terms of market cap. Solana is definitely a big focus for us. We're also looking at some chains that are very focused on RWA. I think, T asset is just one component, but D.O.R, which is building the benchmark rate, RWA is going to allow institutions to come in or people to rehypothecate these assets when they bring them on chain, and having a benchmark rate, having indexes would be very important as well. So that's really as simple as our criteria, right? Looking at users, looking at the use case behind D.O.R.
We wanted to transition to discussion of D.O.R, and part of the reason Connor brought me on the podcast is I have a lot of experience with LIBOR and SOFR. LIBOR transition to SOFR. We thought it makes some sense before we get into the digital offered rate ecosystem to sort of give the TradFi analogies. LIBOR, some people date it to the 80s. In reality, the first use of LIBOR was back in the late 60s. The world then for young people was a lot different. Okay, so you had the Cold War going on, you had petrodollars being generated offshore, and you had a U.S. regulatory environment that limited the amount of interest that could be paid on deposits in U.S. banks. So a Saudi sheikh or a Russian, the Russian government, back then it was communist, wouldn't want to put their dollars on shore, and even if they did, they were capped on the rates that they could earn. And so those dollars were held offshore. And in the late 60s, there was a famous loan involving British banks and the Shah of Iran. And the borrower, the Shah, was and the banks were trying to come up with an interest rate that would float with the cost of funds of the banks that would have to meet periodic draws by the borrower, the Shah. And the Shah didn't trust the bank to sort of represent what its borrowing rate was for obvious reasons. They were conflicted. And the bank was not interested in taking lending risk if they couldn't be sure that the base rate would reflect cost of funds. And so the idea was, we're going to pull other banks like us and have a basic methodology that will approximate general borrowing costs. It may not be Bank A's borrowing costs, but it'll be large London banks borrowing in representative amounts. And that sort of started in the late 60s. There's a Greek banker that came up with the idea. And between the late 60s and the early 80s, that was kind of a clubby thing, very private, done offshore for large loans. In 1981, sort of generally, the first swap occurred, which involved IBM, the World Bank, and it was essentially a back-to-back loan. So one person borrowed at fixed, the other person borrowed on the exact same terms, principal repayments and everything floating. And if I'm paying you fixed and you're paying me floating and the principal exchanges cancel out, we've got an interest rate swap. We're exchanging fixed versus floating on a hypothetical principal amount or notional amount in the swap world. Shortly after 1981 and 1984, the British Bankers Association kind of formalized and took over the setting of the LIBOR rate, then called BBA LIBOR. And that activity started to take off. You started to have derivative activity, and ISDA came about in, I believe, 1984, which was very important. And that's the world I started out in as a lawyer. It was very important because it standardized the documentation with the code of standard wording and master agreements and standardized confirmations. And so you all of a sudden had this infrastructure and groundswell of interest in having a standardized rate. The most important thing is that LIBOR rate was an unsecured interbank borrowing rate. And back then it was based on real transactions. Barclays is borrowing from Royal Bank of Scotland for 3 months or 1 month or 6 months unsecured. And so that data was taken, and if there wasn't sufficient real world activity, back then it wasn't a problem, there was plenty of real world activity, but if there wasn't, they could estimate what their borrowing rate would be and submit that. And so that's how LIBOR kind of grew up, and it went from a clubby interbank unsecured borrowing rate into the dominant rate, really not only rivaling but surpassing in use treasury rates, which a long time ago were also a benchmark, because the treasury was kind of credit-wise so far removed from private sector borrowing that LIBOR was viewed as being a more representative benchmark for the private sector. And so, as I know Brandon's talked about in various podcasts and other things he's written, the problem was over time, for regulatory and other reasons that are beyond the scope of what we're talking about, the amount of interbank borrowing for real declined. Basically, regulators didn't like banks borrowing unsecured because that availability of that borrowing was always subject to concerns about the credit risk of the bank. And as real world activity of term borrowing declined, that meant the number of estimates going into how LIBOR set grew. And when you start estimating, that opened the door to manipulation or fudging what the rates were, because it wasn't based on the real world. It was based on an estimate. And you have no way of knowing if my estimate's being shaded one way or the other because I have some incentive. And so this kind of really came to a head in the financial crisis. There were accusations that banks were not representing what they could actually borrow at because they didn't want to tell the truth and thereby indicate to people that they were under financial stress. There were also some allegations that regulators were telling banks to shade their submissions because they didn't want a financial system problem. And so the bottom line is that the reliability and the trustworthiness of LIBOR settings declined. And so starting in 2017, culminating in 2023, there was a move orchestrated by the Federal Reserve to replace LIBOR with a different rate, SOFR. SOFR has some positives. It's based on trillions of dollars of repo activity every day. So lots and lots of data, and that activity, really has never locked up or ceased, no matter how stressed the financial system is. The problem with SOFR is it's an overnight rate, and repo, for those of you that don't know, is essentially overnight borrowing secured by treasuries. It's secured overnight borrowing. It's not unsecured borrowing. And again, while SOFR has replaced LIBOR, it's based on a rate that's overnight and secured. And so that creates lots of problems for users who prefer a term rate, a 3-month or a 6-month rate, an interest period set rate. And also lots of borrowing occurs that's not secured by treasuries, obviously. And so there have been a lot of bandages that have been applied using futures to approximate term SOFR and other things. But long story short, it's not an ideal replacement, but at least it's based on large volumes of transaction. And frankly, from the Fed standpoint, it's a rate that gets set in a world that they have more direct influence and control over, which wasn't the case when LIBOR was being set in London. So, that's kind of a background. Even in the TradFi world, these benchmark indices, which are crucial in terms of forming the building blocks of borrowing and lending, are still not perfect, and they have challenges. I've alluded to some of those. You need real activity to inform the rate, not just guesses. You need proper incentives so that people don't try to manipulate the data that feeds the benchmark rate. And you also need a rate that is generated by participants and reflects an economic reality that's useful to the broadest possible mass of people, because the more people use a rate because they feel comfortable about it, the more liquid that rate is and the more accurate that rate is, because it's not being dominated by a few players. It actually reflects a sort of consensus of a large number of financial market participants. So with that tour through history, maybe Brandon, you could talk a little bit about, decentralized offered rates in the digital world and what Treehouse is doing and how you think about formulating that benchmark.
No, that's a great run through of the history, and in fact, a lot of things that you mentioned are new to me, and I don't think I can even find that in literature or books. So thanks for that. I'm gonna definitely take some snippets of that. And yeah. So how does D.O.R fit into all this, right? I mean, basically our idea is that whatever you mentioned, there's TradFi benchmark rates. If we're to apply that in the crypto world, we're gonna need a form of a benchmark rate. There are instances of them already. There's like CSR. I think Kraken has one. CoinDesk and CoinFund has one as well. They're essentially very centralized benchmark rates. So our view really is that when you look at crypto and Ethereum specifically, it's a decentralized economy, right? It's a decentralized world. So if we're to build a benchmark rate of sort, rather than rely on one intermediary, let's create a concept with some incentive structures in place that can power a decentralized benchmark rate. So D.O.R, which stands for Decentralized Offered Rate, is essentially that. And how it works is that we take attributes of LIBOR, attributes of SOFR, we try to build it in the form of an oracle. We've also added in staking and slashing as incentives and disincentives against the manipulation and collusion that happens for LIBOR. And finally, we've also introduced 5 different stakeholders that work together to collectively power this new primitive. So to kind of walk through the 5 different counterparties that are involved in the D.O.R system, the first of which is an operator. And an operator runs similar to the way Eigenlayer powers, different AVSs, is where if you want to build your own benchmark, you can run, you're basically an operator, right? You create the terms, you set the rules, you also recruit the next type of users that are going to be among the 4 of them. So the second one is a panelist. And a panelist essentially is a data provider. And if you get enough, the law of large number, you can get enough such that you distribute that workload where all of them are incentivized to do a good job in whatever the benchmark rate is supposed to do. The third role is called a referencer. So when you break it down, the first 2, I would call them like the sell side, and everything else will be on the buy side. So referencer are people that are using these D.O.R benchmarks that are built by the operators. And in our case, we are working with several protocols that are already using us, using elements of it. And we're also using it in the CeFi world. So we're working with some large market makers to power Ethereum staking rate forwards, referencing our D.O.R ESR benchmark. So that's a our goal is to hit 1 billion trading volumes by the end of this quarter. So very exciting. That's all happening OTC. And then just to kind of briefly talk on in terms of the other two roles, there are basically delegators, which is where TETH can be used to stake and help power the crypto economic security of the D.O.R system. And then finally, the end users, which are basically anyone that ends up working with the referencer. So they might not exactly know that D.O.R and benchmarks are powering the products that they're using, but obviously they're an extremely important piece of the puzzle.
So you're building your rate then entirely detached from the TradFi world. Like in some situations in the TradFi world, people look to the risk-free rate, which is a treasury rate, and then build off that. As I mentioned in the past, they would look to the LIBOR rate or the LIBOR swap rate and build off that. But it sounds like this is a different ecosystem. Therefore, you want your data to be solely from the crypto sphere, whatever protocol you're dealing with. Is that right?
So it's more of a framework to build a benchmark that suits certain use cases. So I mean, ultimately,
Right.
depending on the type of whatever you're doing, a benchmark referencing the proof of stake yield might not be the best benchmark. So I like to park it into three types of benchmarks that can be built on top of D.O.R. The first of which is very similar to the interbank world in TradFi. So if you bring it back to DeFi, that's like you borrowing between Aave, borrowing on Compound, and that's all secured, right? You have to over collateralize as well. You have to post some form of collateral, and then you can borrow out there, and that yield that you're borrowing can represent a form of the interbank rate. So that is on chain. That data that you get is on chain. The second kind would be the equivalent of the treasury curve, the treasury rate in traditional finance. And then if you come back to DeFi, that's inherently the proof of stake rate for Ethereum, right? So that depending on the kind of blockchain that you build, there would be tweaks here and there. And then the final one would be the implied like risk-free rate. So how I mentioned it earlier about gold, where you can derive a risk-free rate on it. It's not perfect. It's very volatile, but you can technically still do it. You can also do that in the crypto world. Now, in theory, I mean, think of D.O.R as a framework, right? It's our hope that if you bring LIBOR, if you can even take the actual LIBOR and try to put it into our system, and it hopefully will work even better than how they do it right then and there. So the goal is that there's incentives behind. So you mentioned, earlier that LIBOR, a lot of it as history kind of went on, was just a guesswork, right? It was just banks kind of throwing it. Even if
Right.
they lied about it, there was no penalization. Even if they were super far off, there was no way to kind of tell whether they're right or wrong because it's just a up in the air kind of number. So technically, as long as it's a benchmark that is, whether it's deterministic or it has, or there will be a variable that will come out in the future, whether you will know what the fact would be, D.O.R can be a framework to build that benchmark for you.
Right. So you talked about incentives, and so one of the things I did read, I guess your protocol paper, and focused, of course, on this section.
Mhm.
And one of the things that I kind of wrestled with was if you're incentivizing people for accuracy and slashing them or penalizing them for inaccuracy, have you not created incentives for them to drive activity or data to to show that they're right and therefore get rewards? In other words, you have incentives for accuracy, but those same incentives could motivate people to conduct themselves in ways that help them win and help them avoid slashing. So I guess, can you talk a little bit about that?
Yeah, so I mean that's a big problem, right? I mean, we're aware of that as well, and that's also an issue that is inherent in the traditional finance world, right? It's just that whenever
Right.
there's always loopholes in general, or there's certain gaps, and how we, I mean, I like in the current implementation of D.O.R being so new, it's only been out for less than a month mainnet when we launched it, right? It's gonna take time for us to get there, but we want to build in enough checks and balance. We want to build in enough disincentives and incentives both, such that the effort for them to do something like that would be way harder. For example, if you have like 50 panelists involved, and we take, only the top, we randomize, say half, we only take 25. So even if you try to manipulate the data that you submit, they're in the long term, hopefully we build up enough checks and balances, again, as I mentioned, game theory principles, such that it's going to cost you too much to even do that.
Yeah. So, part of it is, the risk seems higher in the sort of initial stages of any D.O.R, right?
Yep.
Eventually, if you have different kinds of players and you have more players, then the benefits of random sampling has more power, and therefore you can reduce the risks. But certainly early on, it's something that you would think there would need to be some kind of monitoring of, just to make sure nobody dominates the setting of a rate initially, until you have enough players where some of these other structural things you've developed have more efficacy. I guess the last question I had, thinking about your decentralized offer rates, part of it is these rates seem to be driven. For example, if the activity is a staking rate based on Ether, it's kind of like SOFR, right? Which is that activity tends to be Ether secured. And so just like SOFR is treasury secured, you can get a kind of homogenization because as long as the rails function, the risk is Ether's volatility and the level of over collateralization you have in the activity that's providing the rate information. So I get that, but once you start expanding to, I guess I'm a little skeptical about the ability to have offered rates that are detached from one type of secured crypto lending, just because there's so much variability across ecosystems, across countries, regulatory, counterparty, even grid risk, like how reliable is your grid in Nigeria versus, Luxembourg? It's just different kinds of risks. And so it seems to me that you're going to ultimately have multiple offered rates that, to the greatest degree possible, is sampling data of a consistent type of transaction, like an oversecured Ether borrowing.
Yeah, that makes sense. It's we're still early on, I'll say, but I completely hear what you're saying, and it's gonna be tough. There's so many, like, I have the same concerns that you have, but just the same way in TradFi, we use LIBOR for 40, 50 years, right? And it wasn't the best model. It ultimately comes down to convention, right? And while some conventions may not be the best, it's still the best in that, for at that moment, right? So, and having convention also help, keep the market more efficient, right? Like, just like like, for example, credit ratings in traditional finance, all Moody's, S&P, they will only downgrade after the fact of the news coming out, right? So it's like, what's the point of even
100%.
having them, right? It's clearly mislabeled. In the '08 crisis, the way AAA bonds were being rated, and then underlying it was just repackaged mortgages that were subprime. So there's always going to be these issues. What we're trying to do from our end is to create a framework for people to try and solve and create new conventions, and to create a structure for you to fight against, the possibility of collusion. And hey, now you have this benchmark, you can build more things. Just like what I mentioned, we're starting off with the very, very basic fundamentals. We're starting off with forwards, right? So trading forwards, and then using that data as more and more data comes in to build a term structure. And from there on, you can do interest rate swaps. And hopefully down the line, you can do like swaptions. We're still very early, but it's needed infrastructure. We're going to need a benchmark, and it's either you choose a centralized version. Hey, trust me, I'm going to do all the data. I'm the big exchange. Let's use this. Or, and we're not competitive to them, because they could actually use D.O.R as well, right? Again, we're just that data framework, or a data layer. You can use us to help add all these elements to decentralize it as much as you can.
Yeah. I could easily see, like, if you built a robust, Ether staking, liquid staking index, that was based on either direct staking yield, or in the case of, secondary activity, over collateralized borrowing secured by ETH. I mean, you could see a world where that index becomes sufficiently robust that if you're borrowing in the Arbitrum ecosystem or against Arbitrum, you're going to use the ETH index plus 150 or whatever. And it becomes like LIBOR, the benchmark for other activity that may not have the same volume and obviously wouldn't have the same risk factors as what occurs in the Ethereum ecosystem. But I mean, I think it's very interesting, and you should be, commended for trying to build this out, because it's definitely needed.
No, that's awesome. Great discussion there. The analogy I was thinking about is like prediction markets, like Polymarket, for instance, or Kizzy. Like you can permissionlessly bet on an outcome of an event, say like a pro soccer game, and you could have collusion if you could potentially influence the outcome of that soccer game. But I liked the idea of sampling, say 25 out of 50 of like the validators, or I forget what the term is in your ecosystem, but the people that submit rates, because then not everyone's included. So even if they do borrow and lend or other DeFi activity to try to make the ending rate close to what their estimate was, they might not always be included in the incentive pool. And so I think that's like a pretty good way to combat that. We're almost at time here, so just want to talk really quickly about the first month of D.O.Rs on mainnet and Treehouse Nuts and how they play a role in your ecosystem. And then we can wrap.
Yeah, sure. So Nuts is the points value that we ascribe to people that support our ecosystem. So there's two ways you can participate. The first of which is through TETH. So users can directly stake into it. And again, as mentioned, you earn this additional pickup in yield to the arbitrage strategy that we deploy. And then, so again, based on the number of TETH that you hold, you get a subsequent set number of nuts, or points. In terms of D.O.R, in terms of how you can participate, so D.O.R is very much a more B2B product, right? It's I would say the end user retail won't necessarily be facing this product directly, but they would definitely, hopefully, in the future might touch it in some form of way without even knowing it, right? So from that front, in terms of what we're doing, we have already signed on 15 different panelists, right? I mentioned a bunch of different market makers. Some of the biggest staking houses are already onboarded. We have protocols building on top of us. We have a group of PhD guys working on a ERC 6123. It's like a new concept to bring what James was mentioning about how creating like an ISDA version on-chain to help settle on-chain swaps. And they want to reference D.O.R as well. We have certain risk curators of borrow lending protocols that are trying to create instances where they're trying to make a more efficient way to calculate the cost of borrowing on-chain. So these are just some of the examples of the ecosystem of protocols that are building on top of D.O.R. We also have like a grant program. So if anyone out there that's listening that's interested in building fixed income on chain, we can support you there. We also have an eco fund. We're working directly with funds like GSR, Mirana, LeapBlock to invest in projects that are building on top of Treehouse. So not this D.O.R, not necessarily there's an ascribed amount of nuts based on how much you built, but nuts is just essentially coming back to it, what you use to kind of value your contribution to the Treehouse ecosystem.
Awesome. Well, guys, this has been great. Thank you both for coming on, and Brandon, especially thank you to you for coming on and telling us about Treehouse. So super excited to see what you guys roll out over the next year, and we'll be in touch.
No, thanks for having me. It's really nice meeting you both, Connor and James. Take care.